Usually when we talk about a medical diagnosis, there's this expectation of like total precision.
Oh, yeah. Like it's just math to people.
Or it's like engineering. You break your arm, the x-ray shows that, jagged white line, and the doctor just points and says, well, there it is.
It's comforting, honestly,
Mhm.
because we really like things to be visible, to be neatly categorized and just indisputable.
Exactly. But then, you step into the world of corporate finance and suddenly that x-ray machine, it just doesn't work the way you think it does.
No, not at all.
We're looking at a diagnostic landscape that is, well, it's murky, like really murky.
Yeah, that's putting it mildly.
Right. So what if the biggest corporate bankruptcy in history, an $11 billion fraud, and the reason your favorite tech company's real value isn't even on paper? What if all of that comes down to one single accounting document?
It really is the definition of diagnostic muddy waters.
Mm.
And that is exactly what we are wading into today in this deep dive.
We really are.
We need to look past the surface numbers, to understand the economic reality they are desperately trying and, honestly, sometimes completely failing to capture.
Man, I am so ready for this. Welcome to today's deep dive. I'm so glad you could join us today. Tuesday, August 25, 2026.
Glad to be here.
And I should probably note right up front, the extensive research and data collection for the source material we are unpacking today, that was conducted yesterday, August 24th, 2026.
Right, fresh data.
You are tuning into Macroeconomy AI, and the title for today's deep dive is Understanding the Balance Sheet. Thank you so much for being here with us.
Absolutely.
But before we jump in, a quick reminder for you to like, comment, and engage with the content. You are watching channel Macroeconomy AI, bringing a compilation of analyses and news on macroeconomics, technology, and artificial intelligence.
Make sure to hit that subscribe button.
And a huge thank you to today's sponsor, TechLedger Analytics, providing next-generation data visualization tools for financial professionals. When the numbers get dense, TechLedger makes them clear. Find out more at the link in the description.
They're great.
Okay, so let's unpack this document, the balance sheet, or the statement of financial position, if we're being formal about it.
Right, the formal title.
What is this, really? And why is it such a completely different beast compared to, the rest of a company's financial report?
Or the foundational difference, it really comes down to the core equation, right?
Mm-hmm.
Assets equal liabilities plus equity.
Okay.
It is essentially an inventory, of a company's present economic resources, the obligations it owes, and then the residual interest left for the owners.
Just a big list.
Right. But the true distinction between this and, say, an income statement or a cash flow statement is how it handles time.
Ah, right. Because the income statement and the cash flow statement, they're tracking flows over a period of time, like a quarter or a year.
Exactly. They measure motion.
Yeah, I like to think of the cash flow statement as a video of the company, and the balance sheet is just a freeze frame photograph. You hit pause, and bam, that's your balance sheet. It's a static instant.
That's actually a really helpful starting point, but we're going to have to push past that metaphor pretty quickly.
Oh, really? Why?
Because if it is a photograph, it's one that intentionally crops out, like, the most critical elements of a modern business. A key strategic insight from the analysis we're looking at today is that the balance sheet does not represent market value.
Wow. And this is where my mind gets blown. I mean, we're in 2026.
Right.
If you look at massive tech platforms, the Ubers, the Airbnbs, these giant software companies, their biggest assets are their network effects, right?
Oh, absolutely.
Their algorithms, their human capital, their corporate culture. But according to the current international standard, what is it, IAS 38?
Yeah, IAS 38.
Those internally generated intangibles are just completely forbidden from being recognized as assets. How is it even possible that a tech giant's most valuable assets are entirely invisible in this financial photograph?
I know. It sounds totally counterintuitive. Like, why would standard setters intentionally ignore the most valuable parts of, a digital economy?
Exactly.
But the mechanism behind this rule is pure prudence.
Prudence.
You have to put an asset on the balance sheet. It has to be identifiable. You have to actually control it. And this is the kicker. You must be able to reliably measure its future economic benefit.
Oh, I see.
If we allow a CEO to just internally value their own innovative corporate culture, what's stopping them from just declaring it's worth $50 billion?
Yeah.
Just to hide a massive crippling debt problem.
Okay, wait. Yeah, I see the danger there. You can't put a reliable, objective price tag on, like, good vibes or a really smart engineering team without inviting total manipulation.
Precisely. The standard setters, they prioritize reliability over relevance in this specific case.
Makes sense.
And this is exactly why you cannot evaluate the economy of a business by looking at the balance sheet in a vacuum. You just can't.
The whole picture.
You have to read it alongside the other mandatory statements and, crucially, the explanatory notes.
Right. The notes.
Yeah, the notes are where management actually has to detail the assumptions and the judgments they used. It reveals what those rigid numbers on the balance sheet might actually be hiding.
Okay, so if management isn't allowed to just invent their own subjective numbers for these assets, that leads to like a much bigger question. Who actually writes the rules on how we measure these assets and liabilities? And what happens when those rules clash, depending on, say, where a company is headquartered?
That brings us to the great divide in global accounting, really. On one side, we have the International Accounting Standards Board, the IASB.
Okay.
They create the IFRS rules, which are used by over 140 jurisdictions. But then on the other side, you have the U.S. Financial Accounting Standards Board, the FASB, which creates U.S. GAAP.
So two completely different rule books for the exact same global economy.
Exactly. Two rule books, and they clash on some massive, massive structural issues.
Like what?
Let's look at research and development. Under U.S. GAAP, if a pharmaceutical company spends, I don't know, $1 billion developing a new drug, that is treated as an immediate expense.
It just hits the income statement and disappears.
Poof, gone. But under IFRS, if that drug meets specific development criteria, you actually have to capitalize it. You place it on the balance sheet as an asset.
Wow. Which means two identical biotech companies could look wildly different on paper.
Completely different.
One looks highly profitable with massive assets, and the other looks like it's just bleeding cash with nothing to show for it, purely based on their zip code.
Purely based on geography. But, the macroeconomic relation becomes even more pronounced when we talk about inventory. Specifically, the battle over LIFO versus FIFO.
Oh, man. I'm so glad you brought up LIFO last in, first out, because this isn't just like some nerdy accounting quirk.
No, not at all.
This dictates how much actual cash a company pays in taxes during periods of inflation. Yeah. Walk us through the mechanism here.
Okay, let's trace a dollar through the system. Imagine you sell widgets.
Okay, widgets.
In 2020, a widget cost you $10 to manufacture. But in 2026, due to massive inflation, that exact same widget now costs you $50 to manufacture.
Got it.
So today, you sell one widget to a customer for $60.
Okay, so I have a $10 widget and a $50 widget just sitting in my warehouse.
Right. Now, under U.S. GAAP, you are allowed to use LIFO. This means you assume the last one in the $50 widget is the first one you sold. So your revenue is $60, your cost is $50, and your reported profit is just $10. You only pay taxes on $10.
But under IFRS, LIFO is strictly banned, like completely.
Exactly. IFRS forces you to use FIFO, first in, first out.
So the oldest one.
Right. You have to assume you sold a $10 widget from 2020. So now your revenue is $60, your cost is $10, and your reported profit is $50.
Oh, wow. Your tax bill just skyrocketed simply because of the rule book.
Yep. Just the rules.
So U.S. GAAP is prioritizing tax reality, allowing companies to, match their current inflated costs against their current revenues.
Right.
But IFRS prioritizes asset reality because under U.S. GAAP, that ancient $10 widget just stays on the balance sheet forever, completely distorting the true value of the company's inventory.
You've hit the nail on the head. And, these macro-level rules are incredibly sensitive to the broader economy. Like, think about what happens when central banks hike interest rates.
Right.
It doesn't just increase the cost of a company's floating rate debt. It actually forces companies to increase the discount rates they use in their internal valuation models.
Because a higher discount rate mathematically lowers the present value of your future cash flows.
Exactly. And if the present value of, say, a factory or a recent acquisition drops below the value recorded on the balance sheet, the company is forced to take a massive impairment charge, a write-down.
Just wiping out value.
Yeah. Combine that with foreign exchange volatility where, like, a local currency devaluation suddenly inflates the size of debt held in U.S. dollars. And a perfectly healthy operating company can have its balance sheet decimated overnight just by macroeconomic wins.
It's wild. We're seeing how rules and macro forces can completely distort the picture. But what happens when management actively weaponizes this complexity?
Oh, that's where it gets really dark.
Yeah, I want to pivot from how the rules work to how they are broken. Let's talk about balance sheet quality.
Right. So high balance sheet quality means the numbers accurately and conservatively reflect the economic reality.
Okay.
Low quality means management is using all that flexibility in the rules to obscure poor performance.
Yeah.
And there are specific red flags you can look for here.
Like accounts receivable growing aggressively while actual revenue just stays flat.
Exactly.
Or inventory piling up in the warehouse way faster than the cost of goods sold. But, to understand the absolute extreme of low quality, we really have to talk about the WorldCom disaster in 2002.
Oh, man. It remains the ultimate masterclass in balance sheet manipulation.
It really does.
WorldCom was a massive telecom giant. And between 1999 and 2002, they orchestrated an $11 billion fraud. But the crazy thing is, they didn't do it by stealing cash from the vault.
Yeah.
They did it by manipulating the very mechanisms we are discussing today.
Let's break down exactly how they did it, because it's brilliant in a highly, highly illegal way.
Yeah, very illegal.
They took routine daily operating expenses, things they called line costs, which was basically the money they paid to local telecom networks just to use their cables, and they reclassified them.
They literally moved them out of operating expenses and capitalized them as investments in property, plant, and equipment on the balance sheet.
I was thinking about this earlier. It's essentially like taking your daily grocery bills and your monthly electric bill, and instead of putting them in your monthly budget, you staple them to your 30-year mortgage.
It's a solid analogy, but honestly, it's actually worse than that. It's like telling the bank that the food you ate last night is now a permanent structural addition to your house, and it permanently increases the property value of your home.
Oh my God.
It's a complete fiction. By capitalizing an expense, you pull it off the income statement entirely, which artificially inflates your net income. You look incredibly profitable.
And simultaneously, you inflate your assets on the balance sheet, making the company look massive and highly capitalized.
Exactly. But the deadliest part of this mechanism is where it hides on the cash flow statement. Because it's now an asset investment, the cash going out the door is categorized as an investing cash outflow rather than an operating cash outflow.
Right.
So to Wall Street, WorldCom's core operations looked like they were generating massive amounts of cash while they were quietly bleeding to death in the investing section.
And when the internal auditors finally unwound the mechanics of this, it triggered the largest U.S. bankruptcy at the time, and the CEO was sentenced to 25 years in prison.
Yep, 25 years.
Which just proves you can never look at the balance sheet in isolation. You have to verify that the high net income actually aligns with real operating cash flow.
Because cash flow is vastly harder to manipulate with, counting accruals.
Right. So we've seen how easily bad core operations can be obscured behind perfectly legal, or in WorldCom's case, illegal presentation tricks.
Very easily.
Which makes this next point incredibly relevant for you listening today. The problem with financial reporting isn't just fraud, it's the lack of standardization in how companies present their operating reality. And that brings us to a major shift happening right now, the transition to IFRS 18 in 2027.
This is a monumental transition for anyone analyzing global corporate health.
Yeah.
To understand it, we kind of have to look at the current rule book. Right now, the foundational standard for how financial statements are presented is called IAS 1.
And IAS 1 is notoriously loose, isn't it?
It is so loose. Under IAS 1, a company has a lot of flexibility in how they group items on the income statement. So a company could be losing millions of dollars on their core software product. But if they sell their headquarters building for a massive gain, they could just lump that real estate gain into their overall profit.
Oh, wow.
Yeah, the bottom line looks fantastic, completely camouflaging the fact the core business is actually failing.
So it's a structural loophole.
Exactly. But in April 2024, the IASB issued IFRS 18, which will officially replace IAS 1 starting January 4th, 2027.
So does this rewrite the core equation of the balance sheet, like the assets and liabilities?
No. The balance sheet itself, assets equal liabilities plus equity that remains intact. The seismic shift happens on the income statement.
Okay.
IFRS 18 introduces strict, mandatory categories for revenues and expenses, operating, investing, and financing. And, critically, it mandates a strictly defined subtotal for operating profit.
Let me make sure I'm following the mechanism here. By forcing a standardized operating profit subtotal, IFRS 18 strips away the camouflage. You can no longer hide that real estate sale inside your core software revenue. It isolates the true engine of the business.
Precisely. It forces comparability across different companies.
Yeah.
And, because the financial statements are an interconnected ecosystem, changing the income statement creates this profound ripple effect on the cash flow statement, which is governed by a rule called IAS 7.
How does it change the cash flow, though?
Well, under the new rules, companies will be explicitly required to use that newly standardized operating profit as the exact starting point for calculating their indirect operating cash flows.
Oh, I see.
Yeah, it completely removes the leeway management previously had to flatter their cash flow metrics.
And we are having this conversation in August 2026. This means anyone looking at a corporate financial model right now is essentially looking at an operating system with an expiration date just a few months away.
It is a major risk scenario for comparability. Historical data is going to experience a massive disruption as companies restate their financials for 2027.
It's going to be chaotic.
And I actually want to use this precise moment to explicitly remind you that evaluating these transitions and analyzing how any specific company will fare under IFRS 18 requires highly personalized professional analysis.
Of course.
Nothing we are discussing today constitutes investment advice.
Absolutely. Good reminder. So we've spent a lot of time looking forward to 2027 and these new standards, but I want to connect this to the deep past for a second.
Okay, let's do it.
Because we treat standardizing financial reporting like it's some modern bureaucratic headache. But the truth is, humanity has been fighting over how to structure these ledgers for, 800 years.
It really is a fascinating timeline. A foundational system that makes a balance sheet possible. Double-entry bookkeeping where every debit has a corresponding credit. It didn't start on Wall Street.
No.
No. The earliest known records of this are actually found in the ledgers of exchange bankers at the Bologna Fair, all the way back in 1211.
1211. That's insane. But if you crack open any introductory textbook today, they always credit Luca Pacioli as the father of accounting from the late 1400s. There's a bit of a historical rivalry there, isn't there?
Oh, a huge one. A merchant named Benedetto Catrubli actually wrote the earliest known manuscript detailing the double-entry system in 1458.
Okay.
But his manuscript just sat in a drawer, unpublished. Then, in 1494, Luca Pacioli published his own systematic description of double entry in this massive mathematical encyclopedia.
Wait, so Pacioli didn't actually invent the system at all? He just had access to the Gutenberg printing press and got to market first?
That is exactly the case. To his credit, though, Pacioli never claimed to have invented double entry.
Oh, he didn't?
No, he was very clear that he was simply documenting the sophisticated systems that Venetian merchants had already been using for 2 centuries. But because he published it widely, his name is the one permanently etched into the history of finance.
That is incredible. It's like the 15th century equivalent of standardizing IFRS 18. He just wrote down the definitive rule book.
Exactly. And if we synthesize everything we've unpacked today, it's a remarkable journey. We started with the realization that this static snapshot completely misses modern intangibles like human capital and network effects.
Right.
We explored the complex, often contradictory global rules of IFRS and US GAAP and saw how inflation and interest rates interact with things like LIFO and discount rates to just totally reshape reality.
Yep.
We looked at the destructive mechanics of manipulation in the WorldCom fraud. And finally, we saw how the landscape is bracing for a new era of transparency with the incoming 2027 shift to IFRS 18.
It is a massive amount to process, but it fundamentally reorients how you assess the health of any organization. And it leaves me with one final provocative thought to leave you with.
Oh, let's hear it.
As artificial intelligence begins to write complex code, design architectural blueprints, and manage global logistics, will we eventually need an entirely new accounting standard just to value an AI's intellectual capital on the balance sheet?
That's a huge question.
Right. If a neural network is effectively running half a corporation, shouldn't that invisible asset finally show up on the photograph? Definitely something to mull over.
It really is a brilliant and vital question for the next decade of finance. And before we close, legal notice. This content is exclusively informational and educational, compiling data, projections, and analyses from public market sources. The material does not express an ideological bias and does not constitute an investment recommendation, financial, legal, or tax consulting of any nature. Economic and technological projections are subject to frequent revisions in light of new data and market facts. Likewise, past performance does not guarantee future returns. The objective of this space is to introduce concepts and stimulate academic and professional debate. Strategic, financial, or patrimonial decisions require in-depth and personalized analyses. Therefore, always consult qualified professionals and experts before making your decisions.
Thank you so much for joining us on this deep dive into the muddy, complex waters of the balance sheet. We hope the diagnostic picture is a little bit clearer for you now. We warmly invite you to join us for our future explorations into the forces shaping our economy. That was today's Macroeconomy AI. We'll leave it here. You all stay well and keep an eye out for our new broadcasts. Subscribe to our channel, access the links, and follow Macroeconomy AI on social media.